This is a session on LCFS, that's Low Carbon Fuel Standard Market Update. So if you're in the wrong class, feel free to take off and no hard feelings. My name is Jordan Godwin. I actually moderated this exact same panel in this exact same room a year ago. So happy to be back. I'm a senior journalist at the Oil Price Information Services. That's OPIS, and we track daily prices through a broad range of different commodities and energy markets. And I look after the particularly biofuels assessments, and I am part of a team that assesses the LCFS credits on a daily basis. So we track the prices, talk to traders and brokers in the spot market, and we also provide frequent news articles and updates on things that are going on in the program. So today I'm joined by two esteemed panelists and LCFS experts, and today we'll have to start out with, we'll have Philip Sheehy. He's the technical director at ICF based in San Diego. And he told me I wasn't allowed to read his bio, but not the full bio. But the sweetened condensed version is he is part of a consultant and advisory team that is particularly focused on LCFS, and but does a broad range of different forecasting, regulatory impact assessments, and fuel pathway support, as well as administration and verification support. So I'll let Philip take the floor. Thank you very much.
Are we standing or sitting? Am I loaded? Can you guys hear me okay without the mic, or do I need to speak into the mic for the recording? I do need to. Okay, for the recording. And afternoon, everybody. How was lunch? Good. We got more people trickling in, so I'll speak slowly. All right, thanks for having me. So my name's Philip. I'm with ICF. I sit in the San Diego office. So my objective here is to provide an overview of the LCFS program. I think there's probably some people who have some familiarity with the program, some people who are less familiar. So I've got some overview of that with some commentary on recent changes that CARB has put out. I see Sam is not here, so I can get some shots in before he joins us. I was at another conference in March, and I had some critical things to say for Sam, and I've tried to tone those down. So of CARB, and Richard Corey was there too, so I toned it down a little bit. But so I'll get through this. I don't have that many slides. I think I'll get through this. Yep. Okay, that's about ICF. Jordan actually already covered that stuff. I show that slide just to show like my purview of the program is based on our engagements, and so we do on the front end we do forecasting for folks, and then we do actual regulatory support. So we have, and then we're doing life cycle analysis, like which is how fuels get into the market. So we have I would say, or one of the benefits of my team is that we have one of the broader views of the program. So that's kind of that informs you as to like what my perspective is on the program, and like how like that informs your view of my commentary and how full of BS you think I am. So this is like the conventional market pre-LCFS, right? So you've got extraction and refining and then refined products, gasoline and diesel, going into the light duty sector versus medium duty and heavy duty vehicles, on road and off road. And you have some blending. California is a reformulated gasoline market, so you have some blending, typically of corn ethanol into gasoline, around 10% by volume, depending on the season. And then along comes LCFS, which changes this drastically. So there's some gaps in this slide that we'll fill in. So I'll try to get through them. So I've bucketed this based on the ways that we look at the program when we're trying to understand compliance, what it looks like, how it's going to change over time. And so these broad buckets give us a feel for how things are going to change. So the program is a simple administration of credits and deficits. Any fuel in red on the slide generates deficits. Those deficits must be offset with credits on an annual basis, okay? And it's different than other carbon markets. There's no vintages. There's no holding limits. There are restrictions on who can enter the market, but I would say it's a simpler system than some of the carbon markets people are accustomed to. So in short, gasoline and diesel production yields deficits, and those must be offset with credits. So anything in green is a deficit generator. So right away, the ethanol sector, blending corn ethanol generates some credits immediately. So then you got your conventional fuels. So biofuel blending in the pre-market. So now you have some that I have like sugarcane up there. Sugarcane is meant to be like a proxy for feedstock switching or improvements in the carbon intensity of ethanol. And then on the diesel side, we didn't have, we had less than 15 million gallons of biodiesel blended into California diesel pre-LCFS, and that's closer to, I don't know what it is, it's like 100 million gallons now, 150, something like that, biodiesel. And then we also have renewable diesel blended in roughly 250 million gallons a year right now. And so those are, again, a renewable fuel that's coming to this market as a result of the LCFS. You have, and that bucket again is biofuel blending. We've got another bucket of vehicle replacement, so like an advanced vehicle technology, electrification, hydrogen fuel cell vehicles, natural gas vehicles, and then you have renewable natural gas going into the natural gas sector. And then you have non-road electrification, and this existed, but now it's like credited in the program. So forklifts, BART here in the city generates credits. LA Metro's heavy rail and light rail lines that are electrified generate credits. And then, so that's kind of like the downstream stuff. And then you start mixing in what you can go upstream, and there are limitations on the number of credits that can be generated. But in this case, you have refinery improvements, so improvements at the refinery, efficiency, the use of renewable hydrogen, and hydrogen is used post-cracking, and so you can attach renewable hydrogen molecules to long-chain alkanes and then get that into the fuel supply. And then the last, or one more bucket is what is considered innovative crude. So you generate credits for going all the way upstream, further upstream to extraction. And you can deploy solar steam, which displaces once through steam generation, which is powered by natural gas. Or you can deploy solar PV on site at extraction, and you get credits that way. And then this is like the biggest addition from my last presentation, as I found this jet icon. So that's a high five for me. So and I noticed that the jet fuel is not red. It does not generate credits, deficits, excuse me, but renewable jet generates credits. There's not a deficit and a credit offset. It's just a credit generating addition to the program. All right, so that's an important distinction, because this, like, adding jet would be hard. Or would be problematic, in my opinion. Okay. So in some notes here on like kind of where the market is. So CARB is pretty bullish on renewable diesel, and these are exactly the same observations I made. If you saw my last presentation, like Brad, I'm looking at you, man. It's the same shit, same old stuff. And like these are like some of my observations. It's like, all right, so. On biofuels, like feedstock switching only isn't going to get you there. Like you can only switch your feedstocks to lower your carbon intensity. That only gets you so far. You're going to have to blend higher volumes. And then on biodiesel, like Josh is going to cover some of this. There's like, everybody freaks out about NOx because air quality is king here. And, there's no reason to freak out. I put that up there sarcastically. Then there's like renewable natural gas in the natural gas sector. That's going to get saturated. Trying to figure out other ways to get that in the market. So I like people to understand this. The next session is on EVs. No offense to NACW here or anything, but like EVs have like their role in the low carbon fuel standard program. Like electrification is almost blind to the LCFS at this point in time. There is like LCFS is not driving electrification. That's a policy level decision at the state level. The LCFS is not a price driver for electrification. Nobody's buying electric vehicles to get the $500 credit from PG&E. I get a $200 credit. I'm an EV driver for in SDG&E service territory. It's not moving the needle. So like it's generating credits, but it's not a market pull. Just so I think I'm comfortable saying that. I don't know if that's an opinion or I think it's a fact, but maybe somebody else thinks differently. So and then I'm keen on the innovative crude. I'll talk about that a little bit, but like we kind of expect half dozen projects there. I think that's like where some of the interesting opportunities are, in part because it's like an industrial. So this, do I have a pointer thing on this? Does that work or no? I don't care, but I can stand. No, I don't have a mic then. So basically, I think everything on the left kind of happens at an industrial scale. I don't think it works.
Phil Donahue mic.
Oh, sweet. Look at that. So like this stuff over here happens at like a different industrial scale than this stuff. And so this is kind of like, for me, I almost got Jordan in the head there. Did you see that? No, you're good. I got good now. So like this to me, like this is one of the areas that like we kind of keep an eye on, in part because it's a different level of investment. You know, investing in low carbon biofuels and getting EVs, you know, you got pilot stuff. It's just a different scale, because like here, once this industry is moving on this side of the shop, it kind of like there's a different level of engagement in the program, in my opinion. So I think that was awesome. He just replaced yeah. All right, so I'm very proud of this this transition coming up. So self-advertising here, like I've used this. So we did this white paper with Propel. Propel did a 2-part paper. I had no involvement, for the record, in part 1. But part 2 focused on, like, you know, what's the associated value as the low carbon fuel standard becomes more stringent, as credit prices go up, and understanding that, like, why are prices going up, things like that. So we have some commentary in there, but it's more, to be honest, like the main reason we did that is like trying to get, like we spend a lot of time talking about like dollar per ton and what's eligible, what credits, what deficits. And it's nice sometimes to like pull back and be like, okay, how much money needs to change hands in order to achieve compliance in these markets? And, you know, by 2022, this is like a $4 billion market, right? So it's big now, but like it's billions of dollars that are going to need to change hands in order for this program to succeed. And I think that it's, you know, we get lost in the shuffle of carbon intensity, all these like wonky terms. And like the objective of this was to kind of highlight, look, there's value here, and we want people to understand what that is. So we did these 4, so that's like the background, and you can download that on your own time and read it. I wrote most of it. It's great. So this was released in December. That's not what I want to talk about. So we did this forecasting, right? And so this is, and I have a great story behind this. I'm going to spare you guys, but like it involves like a intercontinental trip and CARB releasing like the ISOR for LCFS like the 2 days before I left. And it was, and so CARB basically changed the whole program in a way that nobody was anticipating. And so here, me and like Propel, I shit you not, me and the guys at Propel are exchanging emails like, credit prices just hit what you forecasted for 2018. You know, I was like, I know, we're there. They're going to exceed it, all this stuff. And then CARB released the ISOR and credit prices tanked. And so in preparation of this slide at the last conference I was at, I found that transition. Look at it, crumples. It throws my work away because it's garbage. And so that's PowerPoint. Thank you. You're welcome. So I figure like, okay, let's talk a little bit about like, you know, what those implications are. So here's our original forecast here. And so, you know, we've got some modifications there. Like the gray line is kind of our band. We think that it doesn't change the market that much. It has some potential too, but I was asked to talk a little bit about, you know, the forecast that CARB has included in their ISOR, which I disagree with. I'll say that. There's very little information associated with how those were developed, but it's flat, right? So it goes up a little bit in some of the post years, but they have this like $125 a credit, which I don't know how you publish that when credits are at 140, but that's all right. And just from a program structure, I wanted to couch that in terms of what is the implication for the premium required to drag low carbon fuels to California. So I took what CARB did and used their assumptions on the carbon intensity of renewable diesel or cellulosic ethanol, which I would argue are the marginal units of compliance. One of those is probably going to be setting the price, and then turned it into $1 per gallon premium that would be required to get that fuel to California. And that's what I've plotted here. So you have like $1 premium today, and that dips over time. I think I did it out to 2030. So I didn't show you the full price here. That's not that fair. I did this graph to 2022 and this one to 2030, but they have the credit prices going up later in time, and that's what this little blip is. But and so I highlight that in part because the implication of flat credit pricing is that those industries are reducing their costs at a rate of about 20% over the span of 8 years. And both of these industries are driven by feedstock price. You know, feedstock price is about 70 to 80% of the price associated with delivering those fuels. And so, if you believe like that, so, basically my point is that getting this 20% out of these costs is a heavy lift. So I think that there's reason to believe that these forecasts are probably light and underestimating the cost that it'll take to bring these fuels into California. So I think that's all I got on that slide. Okay, so my closing thoughts. So I mentioned Sam's here, everybody. So I was more critical. So I took some time to reword this stuff. So I wanted to let's get philosophical. So I was thinking about this program I'm on record as saying like talking about the LCFS is I'm like a pig in shit. So I'm very comfortable. I love talking about the LCFS. It's like my jam. And so just as a reminder, again, like we get caught up in credits and deficits and compliance schedules, and like we yell at Sam, and then somebody yells at another supplier. All these things. It's like, so I wanted to hit rewind real quick and say that. So we have a cap and trade program, and in principle, the low carbon fuel standard is a complementary mechanism which is designed to send a long-term price signal to the markets, which complements the short-term price signal that is sent by cap and trade. So what does that mean? In practice, cap and trade has a steep supply curve towards the out years. You can disagree over when that is, but at some point, allowance prices go up rather steeply. You can have certain interventions which smooth that curve out. But if you, let's just treat it in a vacuum. If that curve is steep at the back end and consumers are exposed exclusively to that curve, as allowance prices go up rapidly, consumers are exposed to rapid changes in prices at the pump, assuming that those prices are passed on to the consumer. If you don't have a long-term policy in place to provide those consumers an option to opt out of gasoline and into something else, then you have like a volatile situation where people are just potentially paying through the nose. And the LCFS is supposed to be that signal. So that's why it's there, right? So that's why we have those things together. And I've already kind of ruined my message here, but that's what you want to encourage, this long-term investment in low carbon fuels. That's what the low carbon fuel standard is supposed to do. And the question that I posed here, which I answered, is I don't have any no animations on this one, sorry. But the question that I asked is the program achieving that goal? And I said, not yet. Or I'm saying, no, it does not, and that has nothing to do with CARB. That has to do with actors in the program, this uncertainty in the financial community, all these other things. And so that's like the philosophical aspect, and now for the market reality. So there is this uncertainty narrative that feeds that is just a beast that is fed regardless of what CARB can do at this point. Just so and that's to some extent moderating what I've said previously. But it's technical. Can the targets be achieved? What credit prices can we bear? And then what are the legal challenges? Josh is going to talk about that. And then is the program on sound footing? Is there some, I don't know if you guys remember, but in 2015, when CARB was in the midst of changing the program, there was rumors. The LA Times published this. There were rumors of a grand bargain between the oil industry and Brown, and that was all bullshit, right? But it's still that's out there, or there was something happening. Just to be clear, I don't know. That was very assertive. there's something going on there, but it just feeds this beast that everybody this uncertainty. Which again, CARB can't there's only so much CARB can do to fix this question without and so. But the reason I bring this all up is because on this side, the regulatory piece was thrown had a curveball thrown at it, and when the 2019 and 2020 targets were changed in the ISOR, and so it kept the technical uncertainty at bay. So that was the trade-off, right? So the program is more feasible. You kind of held that part of the beast at bay, but then now you have these people what is CARB going to do next? People that's assholes like me, right? What is CARB going to do next? What are they going to think of next, right? So it's it's a whack-a-mole beast that you're dealing with, right? So so my last 3 points is the target. What another part of the thing is that the target was changed from 18% to 20%. We thought that 18% was going to be a tough task, and we think 20% is even harder. We have some questions about the feasibility of that, but I would argue that's just splitting hairs to some extent. And then we don't think that a $200 per ton price is going to allow will yield a 20% carbon intensity reduction. And then as a reminder, the consumers who are bearing the cost of this program, are facing an increase in gas. Again, this probably informs some of the actions, like from a regulatory standpoint, but they are facing an increase in taxes as a result of policy changes there, and then an increase on that as a result of this program, and that's exclusive of cap and trade. So I'll close that's all I got for this one, and we'll shut it down, and then I think it's over to Josh, so we have time for or are we doing questions, or you go, and then we should have talked about this beforehand?
I think however folks want to do it, right?
I'm open.
I think interactive's better.
Yeah, if you guys have, if we have pressing questions right now for Philip, we can certainly take those if anybody has a question.
Oh, grab the mic. We got ours, yeah.
I do have one question on this slide, Philip. At the bottom, the $200 per ton pricing probably won't cut it. What does ICF have a figure that it would, theoretically have to hit to, yield that 20% reduction?
So we, when we model compliance, like it's generally closer to $250 to $300 a ton based on a 20% target, but our modeling assumes what we call perfect foresight, so that people see a price signal and then they invest around that, and it that's not how this market operates, unfortunately. But so it's not to say that you absolutely need that. That's just like based on our pricing assumptions and what it costs to deliver fuel to California. So I think the main difference I think between our modeling and CARB's, I don't know this for sure, is we are just more conservative on the price reductions that can be achieved in these markets over the span of 8 to 10 years for some of these renewable fuels, and that I think a lot of it has to do with like competition for those feedstocks. So we see it that the competition for these feedstocks actually drive prices up, not down. So, but again, that's not to say that there aren't options to achieve a price of $200 per ton. We just think that at the margin, there are fuels that require a higher price, which we think the margin will drive the pricing. On an average basis, it actually is less than $200 a ton, but the market, we think, like, again, we assume that the credit price in the market is at the margin, so.
Gotcha.
All right. So I have a question about the impact of electric vehicles. So the EVs right now are a relatively small part of the market in California, but it's growing very rapidly, probably 25, 30% a year, and may increase beyond that. If you think we're going to hit the governor's target of 5 million vehicles by 2030, how does that affect this? You're having a flood of EVs generating a lot of new credits. Does that change this dynamic at all? We treat EV credits as free to the market. The entities that generate those credits aren't relying on the dollar per ton to make them whole, right? So we treat that's happening extraneously. Right. It's going to happen regardless.
Until you achieve, so in the 2030 timeframe, EVs have a very small impact on the margin in our model. Just to be clear, in our modeling, and a small impact on the margin. So if you think about it as a supply curve, EVs just push you down the supply curve on the margin for renewable diesel or cellulosic ethanol, something like that, or biodiesel, one of those liquid fuels, which is likely going to drive the marginal price. So, but it's still just not enough credits to push you far enough down the supply curve to keep credit prices low.
Even with that rapid growth?
It's just not 5 million vehicles isn't that many, I guess, is my point. You still have, just the I don't know what the number, like one vehicle generates like 1 to 2. So, it's just not that big part of the market, just to be honest. Like it's just, it doesn't change. We've been asked, what happens if this sounds bad. What happens if CARB changes something and I'm trying to think of how to word this. I'm recorded here. So CARB has demonstrated a willingness to expand the tent or broaden the tent of eligible credit generating activities, right? So we've been asked okay, so you got your forecasting. What happens if CARB introduces something, like renewable jet, and so just for 1 million credits a year, what does that do to your pricing? And so if you translate that, we've like translated that into the governor's goals and everything, and it's like $3 to $5 a ton. It just doesn't move the needle for like that much for us. So.
Oh, we have another one up here.
Hello. There was a study recently saying that the 26% target is possible. Have you guys looked at that?
No, I mean, I'm aware of the study, but I was not engaged in that at all, and I don't know the underlying assumptions associated with that. I know that NextGen sponsored it. I know who did it. Chris does good work, but I don't know what the underlying assumptions are. But I'm just saying, like, we have a model, like our modeling, we can't go, like, we don't achieve compliance at a 25%, like, just so, like, we've done modeling before the like, so in the 2017, we were asked to like model a 15, 20, 25% signal, and when we got to 25%, we said this program isn't feasible. So that's so I can tell you I disagree with the study and like based on our modeling, but I don't know what assumptions they made. I do think it's important, like, one thing that you get caught up in these illustrative compliance scenarios is like, that makes it hard is like, gasoline demand was higher, and like so CARB's got to put out a compliance scenario. So they're, they're an easy target, because they kind of have to do that, even like, despite all the caveats that, like they can caveat it all they want and people don't care, they're going to hammer them for it regardless. So again, they're in a no-win situation. But one of the things, like, we did some work in like 2012, and so did some others, but we did some work in 2012, and we were off in part because we assumed, like, we were off on gasoline demand. I don't know if David's here. David Dunn and I have talked about this, but like, that is like gasoline demand, or the increase of vehicle miles traveled and more gasoline demand, like that has forget EVs and these other things, that has a huge impact. VMT is actually one of the major drivers in our assumptions. And if some of these other complementary programs that CARB is standing up, like SB 375, those don't have annual targets the way that LCFS does. So if some of those fall apart, again, not because people aren't trying, but if gasoline demand increases, like, our modeling falls apart too, right? Like, so we do model that uncertainty, but gasoline demand has been stronger than people forecasted in 2012, 2013, and that has, the bank hasn't been quite as big as people thought, and there's a lot of reasons for that, but one of them is definitely gasoline demand, I think.
Philip, you just mentioned the credit bank. Sam touched on it briefly earlier, that it kind of, in 2017, it kind of plateaued around like 9 million credits, I think. Is that
Yep.
right? How do you see the kind of credit bank playing out over the next year, 5 years, and what does your modeling show is about to happen, basically?
Yeah, I had a figure that we've done that we showed actually at this panel last year, and it's different now just because the curve has changed, but we still see this like 2022, 2023 timeframe as being a little tricky just because of the way the bank is going to be depleted. And we were off by a year. We thought that the credit bank would plateau in 2018. We long thought that, and we were wrong on that. And I do think the number one reason is gasoline demand. So I want to answer the question, but hedge a little bit. But I do think a lot of it will depend on gasoline demand, which is linked to the types of vehicles that people are buying. That's the other thing, is like, we're bound to some extent by like what our assumptions are made about like light duty cars versus trucks, because the fuel efficiency of those vehicles is different, and people have been buying more trucks lately because gasoline is cheaper, and that, again, that throws off the gasoline demand question. And this has nothing to do with this has nothing to do with the LCFS program. It's just like you're beholden to some of these market realities. So we see, for us at least, the credit bank being drawn down, but again, because if the 7.5% target in 2020 is held, because I don't know what Sam would know better. Like, somebody asked me, like, is that final? And I said, no, it hasn't been approved. If you assume that that's like where the target would be, we have a pretty similar trajectory from like what we've done previously, which is that like the program does pretty well, but then there's this like period in the 2022, 2023 period where it starts to get closer to, the bank is closer to depleted, and where we have, like where I think the change in the program, again, like the carbon intensity targets helps that, but we still see it like there's some thin ice there in that 2022 period. So that's kind of the inflection point. And most of our modeling is 2022 to 2023. I don't know if you should subtract a year because we were wrong on the plateau, but that's kind of like where we're at. So yeah, that's kind of our timeline, I think.
All right. Any more questions for Philip? All right, we'll move on to our next speaker, Mr. Josh Bledsoe. He's counsel in the Environment, Land and Resources Department at Latham and Watkins. His practice focuses on complex infrastructure and development projects, particularly those using low-carbon technologies. He's deeply experienced in climate change law and is a frequent contributor on Latham's Clean Energy Law report, which I actually have bookmarked on my laptop here.
We have one bookmark. Excellent.
It's fantastic stuff, and it actually has very fresh content as of earlier this week, I think. So I'll let Josh take it away.
Is it okay if I stand up? Is there a mic I can walk around with?
Yeah.
Okay.
Need like a long game show one.
Phil Donahue mic. I guess that dates me if I talk about Phil Donahue. So I guess first a little bit about who I am and what I do, and thanks for the introduction, Jordan. So I'm an environmental lawyer for a large multinational firm, and I do a lot of different things. I'm a jack of all trades, right? I'll do straight ahead regulatory work. I will do litigation work. We had a few cases in the Ninth Circuit Court of Appeal. Lauren, you're here. We were engaged on that one together. Strangely aligned with the environmental regulator. That was an unusual scenario for me. Also do project finance work, and I think here it's really interesting in the LCFS space to think about project finance, and I think Peter's presentation on the prior panel was quite good, looking at dairy projects, and you map out the environmental attributes and what the value is there. And then also, one thing he didn't touch on, but I know Peter knows about this, but one thing he didn't touch on was, if you're comparing offset projects versus LCFS credit generation projects for a dairy project, another aspect is the energy content, the energy value for a fuels project is pretty low, but the energy value for an offset project can actually be quite high because of other incentives the state has. One thing called the biomat tariff, right? Bioenergy market adjusting tariff. And so, this gets complicated very fast, and trying to explain all of these uncertainties. I mean, what Philip went through in terms of modeling prices in the future, and then explaining what I will talk about, litigation risk and change in law risk. It's a complicated discussion to have with providers of capital, right? And if what you're trying to do is incentivize people to deploy capital to increase the volume of low-carbon fuels, it's a complicated conversation. The first question you get from people on Wall Street is, what's the LCFS, right? I mean, you're starting sometimes from square one. And so it's a complicated program, and I think it does a lot of different things. Between Sam's presentation, Peter's, others, Phillips, I'm going to blow through a lot of these slides quickly, but I think some background is helpful, especially since Philip reminded me of SB 375. So, there are three ways to reduce the emissions from the transportation sector, right? Number one is have people drive less, reduce vehicle miles traveled. That's what SB 375 is focused on. So think smart growth, think public transit, think carpooling, getting people on bikes, more walking. Second way to do it is, we've seen this in the news recently, increase the efficiency of vehicles themselves. So we have this fight, maybe not brewing, maybe it's actually a fight now between California and the federal government on the mileage standards, right? So that's the second way. The third way is what the LCFS is focused on, which is the carbon content of the fuel itself. Of course, on a life cycle basis for the LCFS. And those things are not isolated, right? They're not silos. There's cross interactions between them, as Philip noted, in terms of gasoline demand and gasoline prices. I mean, this is a very, very simple illustration. And by the way, almost all the illustrations here I've stolen from ARB's rulemaking package. So this is all attributed appropriately, I hope. But this is all stuff that I'm stealing from Sam and his team. And this just shows you how you generate credits versus generate deficits of where you are on the CI of your particular fuel. So I think the role that LCFS is important to recognize. If you look at this from the 2015 emissions, in the state, million metric tons, about 440 million metric tons. The transportation sector is a durable slice of the pie here. And I mean durable in a bad way from ARB's perspective. It's a hard nut to crack. Electricity sector emissions are dropping pretty quickly, right? Industrial sector emissions, either flat or dropping. And there's new initiatives. I mean, folks have talked about them with the dairy digesters for the ag sector, and also Cal Recycle has a rulemaking they're going to be launching here soon in a formal way to reduce the waste sector and recycling sector emissions. Transportation is a tough nut to crack. And so, there's a number of different things ARB is doing to address that sector, but I would say that the LCFS is certainly a critical piece of that. This may be out of date. This was from the scoping plan, and I have the red arrow here trying to show, the slice of this pillar here of what the LCFS would address. I mean, it's definitely out of date, but it has the 18% number. It's, of course, 20% now for the LCFS. But, this gives you some sense of really the core of the scoping plan is what are our emissions projected to be, what's our target, how much do we have to reduce, and then let's slice up that and see from different emission reduction measures. With cap and trade, of course, being the one that is flexible as an insurance mechanism, does less, does more, depending on how the other measures perform. So, hot topics, policy debates, some of this has been discussed already. And in the interest of time, I think the value I can bring to this particular room in this discussion is probably on the litigation front, so I'm going to kind of fast forward and get there. But these are some of the design issues and policy debates about the program, both historically, and most of these are actually still relevant today. We've talked about the credit banking. So I think here is one thing that Philip mentioned, others have mentioned, but they haven't maybe shown it in this stark of a way. So you can see the current program, you have 10% in terms of a plateau happening out into the future. And then the proposal here for 2020, 7.5% as opposed to 10%. And I think this right here, I mean, Phil, this is what ruins your vacation, right? If you're going, okay, there it is. So this was not discussed previously in terms of the workshop. So, the discussion was really here. The discussion was what's the target going to be? What's the slope going to be for the proposal? But there wasn't really a contemplation that this target, and I hate to say it would be missed, but instead of hitting the 10%, in 2020, it's going to be less than that with a steeper back-end reduction. I was going to talk about the key changes in the proposal. Comments are due April the 23rd, but I think Sam did a good job this morning of walking through the changes. CCS here being quite notable. CCS is not dead, right? CCS has maybe been asleep for a while, but the combination of the protocol here from ARB and the tax credits that were pushed through, the 45Q tax credits that were pushed through in the budget deal on the federal level, the combination of those things, let's say, has generated interest, right? I'm getting inquiries, and my colleagues are as well, and some of the consultants I work with, they're getting questions. I think the price signal that could potentially be here should this protocol get pushed through and should projects do LCFS focused CCS projects, it's interesting. So we may actually see some movement on CCS. These are some of the other major changes which have already been talked about. This slide, already saw this morning with Sam. Credit price projections. Philip, much better suited to talk to this than I am, so I'll go through the credit price projections. This is way too small for anyone to see, right? Put 4 different charts here on one slide. But again, this is baseline for volume and credits, and then proposed for volumes and credits. And this is, again, the ultimate takeaway from this slide is, do you agree with ARB's projections? Do you have your own projections? So much is dependent on, what volumes of fuel actually come to market in the out years here, so, the end of the next decade. This I like because it shows what the projected reductions attributable to the LCFS are in the proposed scenario. And so you can see here, it gets pretty substantial, right? I mean, you're looking in the 15 million metric tons per year as you get out in this time frame, the end of next decade. So it's still not as big as cap and trade, but of course LCFS is important for other reasons, right? You could view the LCFS as a stealthy way to reduce criteria and toxic pollutant emissions, right? It's through the lens of a GHG reduction program, but if you look at what fuels and what vehicles have to be used to hit those targets, you're also reducing the other pollutants, so the co-benefits, the co-pollutants. But it's a way of getting at those without going, if you will, through the Clean Air Act. So it's kind of a unique program in that regard as well. So, okay, litigation. This is what I think the reason I was asked to be on this panel. There's a long, complicated history here, and we could talk for hours about this. Thanks for the shout out, Jordan, for our Clean Energy Law Report blog. I've written a lot of articles over the years on this and the blow-by-blow of the litigation. But we've had federal court challenges, one that's essentially over to challenge the California program. You have a federal challenge to the Oregon program, which is important enough for the California program that ARB sent a lawyer up to do the oral argument at the Ninth Circuit on the challenge to the Oregon program. Get to that in a second. We also have state law challenges. You have heard the Poet 1 and the Poet 2 case, which we'll talk about. So I think the point is there's a litigation overlay to all of this, right? A regulatory uncertainty overlay to all of this. So, when Philip's saying, is the price signal, long-term price signal that's being sent by the LCFS, is it doing its job? Is it adequate, right? Peter this morning talked about, are we getting capital deployed? How do we do the project finance here for these, for projects to bring low CI fuel to market? How do folks view the LCFS? How do they view the reliability of that revenue stream, of that credit generation? And, in the project finance world, we call it, it's change in law risk, right? Regulatory risk. And, what you'll see is because of, and maybe this will change once the rulemaking gets pushed through, but what you've seen today are very short-term offtakes for LCFS credit generation projects, right? So maybe it's helpful to give a little context on why this litigation overlay is important and how it's moved the market and how the credit prices have gone up and down over time, right? So, again, let's go back to a dairy digester. It's a nice example. If you generate offsets, so let's say you're capturing the biogas, you're combusting it, generating electricity, sending electricity to the grid. If you do that, you can get a power purchase agreement with a credit-worthy offtaker, a utility, for 15, 20, 25 years, right? And you can get the offsets, which, the Office Cap and Trade Program now, I think today, is seen as more durable than the LCFS, at least right now. So while the value may not be as high, you have two revenue streams there, which I think would be viewed by Wall Street as reliable, especially the power purchase agreement, those sales. And that price is upwards of $180 a megawatt hour right now, which is amazing, considering utility scale wind and solar sell for $40 to $50 a megawatt hour right now. So we're talking a threefold increase in terms of what the price would be. So when you talk about fuels projects for a dairy digester, as Peter's great pie chart showed, 95% of the value is environmental attributes coming from these projects. And so getting providers of capital comfortable with relying on those environmental attributes is a difficult thing. It just in a vacuum. And then you add on the litigation on top of it, it becomes even harder. Okay, so what were the challenges in the federal court about with the LCFS? Essentially the Dormant Commerce Clause. So it's, are you discriminating against out-of-state products or businesses, right? And so what had happened, I won't go through the blow-by-blow here, but basically the state won in the Ninth Circuit, and the U.S. Supreme Court declined to hear the case, right? They denied the writ of certiorari, the petition for certiorari. So because of that, the program, at least the California program, has been deemed to not discriminate against out-of-state businesses. And so that gave the ARB some runway to continue to implement the program, and frankly had the co-benefit of making the cap and trade program less vulnerable, because there's this looming lawsuit that everyone has thought would be coming for years, would be to challenge the cap and trade program on the basis that they're discriminating against out-of-state power plants because they're regulating the importing electricity, right? So you're regulating indirectly a power plant in Arizona for its emissions because that power is being sent to California. But because this case came out the way it did from the LCFS, I think that case becomes much more difficult to win on the cap and trade side. So this was actually a really important case, the Rocky Mountain Farmers Union case. And so here's some of the implications of the U.S. Supreme Court denying certiorari. And I know Corey Ann's here, and with the Oregon challenge working its way through the Ninth Circuit, the oral argument took place last month. And this is, I'm oversimplifying, but the challenge to the Oregon program is very, very similar, almost a mirror image to the challenge to the LCFS. So the thinking is, well, why are you following that challenge? It's the same Ninth Circuit, it's the same circuit court that's going to be dealing with this. And the arguments that you have from the fuels company, the petroleum companies and the trucking companies that are running this case is, well, there's the facts on the ground are different, and so maybe different facts on the ground will lead to a different result. Maybe we can get a split within the Ninth Circuit, and maybe that's red meat for a U.S. Supreme Court, petition for certiorari. So we'll see. We'll see how that goes. Important to note that these companies lost at the trial court level, and it's always difficult to win on appeal, right? But we'll see. So, I guess stay tuned on the federal side. Okay, California challenges. Again, a very long history here. I will try to simplify, but if you want the full blow-by-blow, you can go back and I guess try to read chronologically the blog posts and client alerts we've done over the years. It's a great way to help you fall asleep at night, but it does have the detail if you really want to get into the weeds on it. So this goes way back to 2009 when the LCFS was first adopted, and there was a challenge to the program as not complying with CEQA. It was really a procedural issue. Did ARB comply with the California Environmental Quality Act? Did they do their analysis correctly? And in that challenge, actually, the focus was, did they approve the program before they did their environmental analysis? And that's a no-no, right? I mean, you're supposed to do your environmental analysis first, inform the public, inform the decision makers, tweak the program as necessary, and then you approve it, right? And that's CEQA Law 101. And so there was a slight misstep there, and ARB, ended up, losing that case. And so because of that, they had to re-adopt the program, which happened in 2015. Well, lo and behold, the same petitioner challenged the program again and said, well, we don't think you did it right this time. And so the program was re-adopted, a new CEQA analysis was redone, and the way this works is kind of wonky, and so I'll do a little, procedural, lesson 101 on how it works. So basically, you get a writ of mandate, you get an order from a court. It says, ARB, you shall do this. You shall fix your CEQA analysis. If they do that, you go back to the court and say, hey, we did our job, right? And the court says, yeah, you did your job. Check the box. We'll discharge the writ. You go on and live your life. Well, it turned out that the ARB went back to the trial court and said, hey, we did our job. We readopted the program. We did the CEQA analysis. We did it right. And the trial court said, yeah, you did. Check the box. We're done. Petitioners, and this is Poet, the ethanol production company, said, no. We actually don't think they did it right. We think they messed it up again. So they appealed, and then the Court of Appeal agreed, right? So the Court of Appeal ordered the trial court to essentially order ARB to redo the analysis yet again. And so this gets complicated, and I apologize, but there's really no way to simplify this too much, because you have two separate litigation matters and you have a rulemaking. They're all intersecting in very interesting ways, and if something happens here, it impacts what's going to happen here. So I think that, and again, this is sort of the blow-by-blow of what happened. But today, I guess maybe not really breaking news. I mean, we posted on this earlier in the week, but ARB, in the Poet 2 case, which is a challenge to the readopted program, they filed a MJOP. What's an MJOP? It's a motion for judgment on the pleadings. What's that? They were trying to get the case dismissed as moot, saying, listen, we had the Poet 1 case. ARB did its job. They fixed their CEQA analysis. There's nothing left to do. The Poet 2 case is related to the Poet 1 case. So, hey, we're ARB. We're telling you, court, there's no relief that can be granted. You give everything the petitioners are asking for in this case, it's non-justiciable. There's nothing to do here. The trial court agreed and said, you're right. I mean, there's nothing for us to review. It's not ripe. It'd be premature. So this is a moot case. We're going to kick it. And they did. And then it was quiet. We all knew Poet had the ability to appeal, but they waited. They did not appeal immediately. But then, in March, so last month, they filed their notice of appeal with the California Court of Appeal for the 5th District. And what that means is, on a very narrow procedural stance, you have the Court of Appeal, the same Court of Appeal, which has actually twice ruled against ARB on the LCFS analysis. They are going to be looking at, did the trial court do the right thing in discharging in dismissing the case? So we'll see. And that was probably painful for me. It's probably painful for our review to try to get through the litigation. So what does it mean? What it means is there's uncertainty that remains for the future of their program. And I take a few different views. I can sort of give you the worst case scenario, the midstream, and then the best case scenario. I think most people in the market are viewing the disruption caused by the litigation, including the freezing of the CI curve for diesel, as sort of a hiccup, as somewhat of a nuisance. But the courts have allowed the program to continue. So the courts could have said, ARB, you've messed up the CEQA analysis. We want to send you a strong signal. We're going to vacate the program. We're going to enjoin the program. They didn't do that. They said, listen, we understand that that it's sort of a minor piece of the overall puzzle of the LCFS. We think the LCFS is a net environmental benefit for the planet, for the state. So we're going to let the program continue while ARB goes back and fixes the issues. They've done that twice. But the second time they did, the Court of Appeal, the opinion was actually pretty strong, a lot stronger than I was expecting to see, and a lot stronger than you typically see in terms of a critique from a court to a regulatory agency. And so because of that, I mean, I wonder about the degree of patience that you'll have with the Court of Appeal. So I'm really curious to see how the Court of Appeal deals with this new appeal that they're going to be facing, in the coming months. And there's a worst case scenario where they say ARB is taking too long, right? We've previously ordered them to move expeditiously to readopt the program and do their environmental analysis correctly, and we're approaching 5 years, right, since the initial order to redo the environmental analysis. So there is a potential that the Court of Appeal could have lost patience and will do something more drastic. I think that's still the very low likelihood scenario, and there's a number of procedural things that have to happen. The court would say, no, the trial court messed up. You need to hear the merits. You have to have a merits hearing. Then you got to go to the remedy. So there's a lot of steps in the way, but to get to potential bad outcome for the program. But the point is, the bad outcome is there. It's a non-zero probability, and so since it's there, the market needs to pay attention. And I think part of the issue here is this is so complicated. I think it's difficult for market participants, whether on the compliance side, the credit generation side, or the financing side, to handicap this, right? I mean, I get a lot of questions. Well, what does this mean? And I say, well, it's like when I was a kid. I loved the choose your own adventure books, right? You get to chapter 4, and do you want to go into the cave? Do you want to go across the swamp? Or do you want to catch the bus into town, right? And so that's kind of where we are with the LCFS, both from a regulatory approval process, pushing through the amendments, and the 2 different litigation matters on the state level. And then, of course, the challenge to the Oregon program, which is the wild card, right? What happens with the Oregon program? Does that influence the California program? And so even just the very sequencing of these events are important. So what happens if the program gets readopted before the court reaches the merits? Well, what if the converse happens? And you could have different outcomes. You could have gap periods where, in theory, and I don't think it's what happened, but hard to predict the courts, you could have no program for a month or 2 months, right? Well, if the court vacates the program, and then the program gets readopted. So what happens there? And so, I mean, this is interesting, and I think, ask people like Philip to comment on this, but how does the market react with credit prices, right? What's the degree of confidence in providers of capital that we've seen this sort of fluctuating history of prices? How do we project into the future? How reliable is this as a source of revenue? So I have to say this is the most complicated procedural set of cases I've had to deal with, because you have 2 different cases that are intermeshing with one another and the rulemaking process all at the same time. I mean, one thing that ARB did is you have to do a CEQA analysis anytime you do a big regulation, right? That's a project under CEQA. You got to do the environmental analysis. They did the environmental analysis, I think it's Appendix D to the rulemaking package, for the entire program, right? For the whole entire extension of the program. They also have an Appendix G, which is focused just on the environmental analysis of NOx emissions from the potential increased use of biodiesel that's driven by the incentive of the LCFS, right? So there's 2 separate environmental analyses. Now, they've chosen to do them separately, which I think is smart, but they're doing it along with the proposed rulemaking. So then the question becomes, well, what if folks challenge the rulemaking? Forget about the biodiesel, forget about the NOx. What if there's another challenge program? What if there's a delay in the approval process of the rulemaking package? Does that mean that the court gets even more impatient to say, hey, you still haven't approved this environmental analysis? So complicated, happy to take questions on it, but it's something that I think folks have to be aware of and have to track, because it deals with confidence in the market, which deals with credit prices, and it deals with the ability to attract capital to get more low CI fuels to market. I've sort of covered all these, so I'll just go through, and you've seen this before. Happy to take questions now or address other topics. So
I think we probably have about 5 minutes left for questions.
And I'm happy to stay longer, of course. I know there's other panels and other things happening, but I'm happy to stay longer. We started a few minutes late, but please.
Mm-hmm. Do you have any questions for Josh? Josh, I think I have one. On the rulemaking package, what do you see as some of the kind of more ambitious parts of that scoping plan, and where you think we might see compromise, from the proposals based on, your conversations with the stakeholders?
Well, I think what we'll see is, I guess I'll deal with the ambition one then, and then maybe compromise second. So on ambition, I'm actually very encouraged to see ARB tried to incentivize carbon capture and sequestration projects. So we probably don't need CCS in California to hit our carbon targets, right? But globally, we absolutely need CCS if we're going to have any hope of hitting our global, carbon reduction targets. And so it's encouraging to me that ARB is trying to push through a CCS protocol and get that approved and get that recognized for LCFS credit generation. I think it's ambitious because it's a very understandably stringent protocol in terms of what you have to do to analyze the sequestration areas, and then also the long-term monitoring and financial instruments that are required that have to be posted. And so I think that's an ambitious thing to do, but I am, I would say, I would encourage ARB to keep doing that, because we really need those projects to take off globally. In terms of where compromise could take place, I would say it may be just on clarifying a few things. I think there's a number of places which it's a massive rulemaking package. It's a ton of work that went into it. But there are areas, I think, tweaks around the edges where I know, just from my discussions with stakeholders, they could use some clarity, right? And I'll give one example. Sam earlier today mentioned that renewables projects, renewables going to EV chargers, he mentioned that it has to be within a California or a balancing authority area. From my look, and maybe it's there, I didn't see it, but that's not defined, right? So I think it'd be important to frame that up a little bit. What if you have a project in Arizona, a solar project that actually is delivering into the CalISO grid? Does that count, right? It's not in California, but it's delivering to California. How does that work? So I think there'll probably be some questions and comments, and I imagine some clarity provided by ARB in the final rulemaking package around those issues.
Sure. And one other question, it was just a fantastic overview. I know, like you said, it's very difficult to kind of navigate the Poet 1 and Poet 2 lawsuits. What's next, basically? What's next on the timeline, or what are we waiting for? What will happen next in the way things play out? Yeah,
so two big things to track. I think you should track all of it, but two big things to track on the litigation front. One, what happens with the Oregon program, right? So if Oregon wins, and the Ninth Circuit, basically makes the same decision they made in the Rocky Mountain case for the California program, that's a notable event. It's an even more notable event if the Ninth Circuit, finds that the program violates the Dormant Commerce Clause. That could send ripples, I would say, through the market. The second big thing to watch is what happens with the Court of Appeal in this the most recent appeal that was filed last month. Does the Court of Appeal tell the trial court they got it wrong? And if they say that, I think you'll also see some uncertainty creep into the market, because there'll be the question of, well, what now? We thought that most folks thought this case was essentially over, and now it could be sort of the zombie case coming back from the dead yet again. So I think those are the two big things to watch on the litigation front.
All right. Oh, I think we have one more.
Oh.
Thanks, Colin Murphy from the Next Gen Policy Center. It's not so much a question as sort of an announcement. I know there's a question earlier about the LCFS study that Next Gen series and UCS released that shows a higher level of ambitions available. For anybody who's interested, I was involved in the study with Next Gen who released it, so I'm happy to discuss it. I've got copies of the two-page policy brief for anybody here. I think we're about at end of time, so I'm not going to try to lay into Philip about why he's so pessimistic and hating on the program.
Speaking of laying into Philip, I will take issue with one thing he said about the EVs and whether they're important or not, whether they move the needle. Listen, I'm a lawyer, so be scared when lawyers do math, right? But, my back of the envelope calculations, looking at EV charging stations, let's make some assumptions. Let's say they're charging a vehicle in the year 2020. Let's assume that credit prices are $125. And let's say they're charging that EV with 100% renewable energy. My math tells me that the value of the LCFS credit per kilowatt hour charged is about 14 cents, right? That's a lot. If you think about it, that's $140 a megawatt hour. And I was just saying, utility scale solar and wind, you buy that wholesale for $40 or $50, and that price keeps dropping, right?
That'll cover your demand charge.
That's right. So there's more in electricity rates, as Philip is saying very quickly and elegantly, than just the power charge, right? There's all these different costs. When you look at your electricity bill, that add up. But still, it's still, I think, an interesting price signal, and it makes me, question, whether any EV charging company will not go and try to procure 100% renewables, right? It seems like it would pencil the marginal cost of doing that. It looks like you get it back and more on the back end. So that's interesting as implications for the duck curve and killing the duck and all those things with Cal ISO and, when you curtail renewables and all those things. But, it may not move the overall program, and I would clearly defer to Philip and his analysis on that. But for me, it's interesting because it has these cascading implications for renewable development and renewable deployment in the state.
All right. Thank you all for attending, and Philip and Josh, thank you very much for your insights.